Welcome. The second quarter experienced some modest pullback in both equities and fixed income. It was not as much as I expected and anticipate there is more volatility to come. On nearly all metrics, the U.S. economy continues to show modest but positive improvements. The market bounce in late June after the sell-off indicates the initial move may have been partially tied to profit-taking rather than a major shift in investor sentiment. The domestic markets posted small gains for the second quarter, but again set new all-time highs. For the current quarter, the S&P 500 managed a 2.9% gain and is up 13.8% year-to-date. As indicated in our prior commentaries, we feel this will be another acceptable year for the markets, but we anticipate a pullback to establish a foundation to build on into 2014. We have experienced these market pullbacks 3 major times since the recession, and yet the overall growth of the S&P since March of 2009 is up 160% and is 16.5% above the peak reached in October of 2007. According to the International Monetary Fund, IMF, the global economy is expected to continue mending gradually. Global growth is projected to remain subdued at slightly above 3% in 2013, which is less than forecasted in April. This is being driven to a large extent by weaker domestic demand and slower growth in several key emerging market economies. For the quarter, the EAFE index lost almost 1%, and emerging markets dropped 8%. The CEO Economic Outlook Survey Index, a composite index of CEOs' expectations for the next 6 months, climbed in the second quarter after a big jump in the first quarter. Overall, CEOs view the U.S. economy as still on a slow road to recovery. Relative to economic conditions, business performance remains strong, but the U.S. government's unresolved long-term fiscal path and an uncertain political environment are key obstacles to more robust economic growth and hiring. The current situation has made equity valuations seem reasonable, with the forward PE ratio of the S&P index at 13.9 times, compared to the 20-year average of 14.9 times. Even with the market hitting all-time highs, there's still more room for growth. When examining the current PE ratios, they are below their historical averages. For example, large cap blend stocks are 13.8% cheaper than the historical averages. Domestic growth has been subpar, but the economy has enough underlying durability to maintain modest growth. Real gross domestic product GDP for the first quarter was revised down to 1.8%, and we expect about the same for the second quarter. Even with the slowdown in government spending, we expect acceleration in growth in the second half of the year. The housing and auto sectors should help the economic activity into next year. Even with the slow-growing recovery, we have exceeded the lost output during the recession by $400 billion. The Conference Board Leading Economic Index, LEI, an indicator of economic activity over the next 6 months, increased in the first 2 months, but was flat in June. The Coincident Economic Index, CEI, a measure of current economic conditions, increased slightly each month. These indicators still point to a continuing but slow-growing environment. According to the Conference Board, quote, the LEI 6-month growth rate remains positive, suggesting the economy will continue expanding through the end of the year, end of quote. Governmental shortcomings. We are currently in the midst of a major change in monetary policy that could have a significant impact on all financial markets. Recently, the Federal Reserve communicated a structural change in their policies. This change has already led to some dramatic and volatile moves in the bond and stock markets. In recent years, the Fed has been purchasing bonds in the open market in order to provide liquidity in the system. This quantitative easing has artificially kept interest rates low. This aggressive strategy was to help spur housing and force investors to take more risk on their investments. In late May, Federal Reserve Chairman Ben Bernanke indicated a gradual slowdown in the level of open market purchases from the current $85 billion per month. This structural change caused a mini panic in the markets, but caused massive selling in the bond market. World markets. There has been no generalized global upswing in economic activity. On the contrary, weak demand in Europe has fed into slower Chinese export growth. This in turn depresses trade with other export-oriented emerging economies. The result has been downward pressure on industrial commodity prices and the slowest pace of global GDP growth since 2009. On a positive note, this has helped push inflation towards cyclical lows throughout the world. We could see the Eurozone come out of its recession soon and register positive growth starting early next year. Housing. The recovery in housing continues to provide a significant positive catalyst for economic growth and helps offset the slowdown in government spending and weaker export growth. Existing home sales jumped 4.2%, the highest rate since November of 2009, and new home sales could accelerate by 36% by the end of 2013. Builders' confidence continues to grow with a jump of 22% in new home starts over the last year. These positive indicators should provide a strong foundation going into next year. Employment. The unemployment rate remains high at 7.6%. The job markets are slowly but steadily improving, and this trend should continue for the balance of the year. It is only a matter of time before corporations commit to long-term expansion, which will create jobs. At some point, businesses will take a leap of faith, which will offer a tremendous opportunity and a big boost to the markets. Closing thoughts. We anticipate a very choppy stock and bond markets over the next few months. That being said, we expect equities to establish a foundation and come back from that contraction. A combination of slow growth, low inflation, and relatively low interest rates should allow for stocks to move higher over the next 12 months. Our portfolios are well diversified, which will benefit us as we move forward. Our optimism is based on several factors. Households' finances are in the best shape in decades. The job market continues to improve, a bit slowly. Consumer confidence remains at a 5-year high, and business capital spending should improve over the next 12 months. We still need to worry about our stalled government, the recession in the Eurozone, slower growth in China, rising interest rates, Iran, and geopolitical risks. We have talked with many of you about the silo investment concept I have developed, and the feedback has been very positive. It is a new way to look at your investments and should better align them to meet your goals. Please contact us if you have any questions or concerns about your financial future. We are here to serve you and your needs. Thank you for listening and your continued support.